Watch a raw asset chart and you see pure chaos. The price spikes, crashes, and stutters in a blur of volatile data. Look closer, and you'll see the price repeatedly stalls and reverses at the same specific coordinates. These points of friction suggest a structured environment rather than total randomness. We define these coordinates as support and resistance. These are the locations where supply and demand are forced into a direct confrontation. The mechanics are similar to physics in a confined space. Picture a rubber ball bouncing between a solid floor and a heavy ceiling. The energy of the ball dictates its speed, but the room dictates its limits. In a live market, the floor is support. When an asset drops to this level, buyers step in to absorb the selling pressure and halt the decline. The ceiling is resistance, a zone where sellers step in to stop a rally from climbing higher. To navigate this, we have to construct a complete architectural model of these boundaries, moving from static horizontal lines to dynamic time-weighted curves. Mastering this geometry is the primary way analysts map the distribution of market liquidity. We begin mapping this geometry with the most basic structural limit, the horizontal level. These are straight lines drawn across a chart where price has historically reacted. A horizontal support level forms when an asset repeatedly drops to a specific price, say exactly $100, and rebounds. The market has collectively identified $100 as an area of value, triggering a wall of buy orders. Conversely, a horizontal resistance level forms when an asset continuously fails to break above a threshold, like $150. At this ceiling, the concentration of sell orders is too dense for the price to penetrate. These boundaries are not uniform in strength. To trust a level, we measure its structural integrity by the frequency of its interactions with price. A single touch from price is an anomaly. 3 repeated touches confirm a structural boundary, and 5 touches denote a highly fortified institutional level. The more the market tests the line, the stronger the boundary becomes. A horizontal level is essentially an accumulating historical record of mass psychological consensus. Support and resistance are not restricted to flat planes. When an asset has directional momentum, the boundaries must adapt to the velocity of the move. This chart illustrates the structural requirements of an uptrend. The market prints a continuous stair-step sequence of higher highs and higher lows. Connecting that sequence of higher lows with the green dashed line creates an upward sloping vector, acting as a diagonal support floor. The inverse applies to a market in decline. A downtrend is mapped by connecting a series of lower highs, forming a descending ceiling of resistance. This WTI crude oil chart proves that the same structural integrity rules governing horizontal lines also apply to diagonal vectors. Follow the arrows across the black trend lines. The asset respects the boundary across at least 3 distinct touches, confirming the validity of the slope. By establishing these diagonal trend lines, analysts can mathematically project the exact trajectory and velocity of a market's momentum. The most complex boundaries are not fixed lines at all, but dynamic thresholds that continuously recalculate as new price data prints. We map fluid zones using moving averages. This chart tracks the 50 EMA for the British pound. In the highlighted circular zones, price drops, strikes the solid blue moving average, and reverses higher. The support moves as the price moves. A moving average functions like a mechanical escalator step positioned underneath the price. It carries the trend higher while providing a sequence of ascending safety nets during pullbacks. This dynamic boundary functions inversely during a sustained market collapse. Focus on the thick purple and orange ribbon. Acting as a fluid ceiling, every time the price attempts to rally, the ribbon suppresses it, forcing the asset lower. While trend lines show you the visible angle of a move, dynamic moving averages reveal the continuous, time-weighted momentum operating beneath the surface. What happens when the pressure becomes too great and these structural boundaries finally fail? A breakout occurs when a surge of momentum pushes the price decisively outside the established support or resistance bounds. However, trading an initial breach is high risk due to the pattern visible on this gold spot chart, the fakeout. Inside the black circles, the price pierces resistance, appears to stage a massive breakout, and then violently collapses back into the original range. Institutional players intentionally trigger these price movements to generate the high-volume liquidity required for their own large-scale reversals. Large traders push the price just over the resistance line to trigger the stop losses of short sellers and bait amateur breakout traders. Selling into this sudden spike of retail buy orders, they harvest the liquidity needed to fuel a massive move in the opposite direction. Identifying a broken boundary is insufficient. Without secondary confirmation, a breakout is likely a trap designed to weaponize retail liquidity. To protect against fakeouts, we look for the final unifying rule of price action: role reversal. When a boundary breaks, its function inverts. Old resistance becomes new support. Watch the line graph. Price surges through the orange bar, then pulls back to retest it from above. The old ceiling is now the new floor. This also works in reverse. When an asset falls through a support floor, that level immediately hardens into the new resistance ceiling. Think of a door in a hallway. Pushed from one side, it blocks entry. Walk through and look back, it blocks your exit. Look at the yellow circles. The instant the market bounces, the red resistance line transforms into green support. This theory translates to messy, real-world charts. Role reversal governs dynamic levels too. After price breaks past the moving average at the bottom, the 50 EMA, previously suppressing price, turns into support. By synthesizing these static levels, diagonal vectors, and dynamic averages, you create a framework to navigate market volatility. This geometric model provides a consistent map for identifying high-probability zones of supply and demand.